What does it mean to be your own banker?
That's a good question that we get to answer every day here at McPhee Insurance. And today we're excited to share that answer with you.
Imagine a world where you get to collect the interest on everything that you finance instead of the bank collecting that interest. How would you like to become your own banker without having to jump through all the hoops and the regulatory stuff that a bank has to do in order to become a bank?
Let's start at the very beginning. That's a good place to start. If we're going to know how to be our own banker, we need to understand what a bank is.
A bank is a business which makes money by managing other people's money. And just like any business, a bank is in business to make a profit. A bank makes profit by lending money which isn't theirs to other people and businesses. The difference between what a bank pays their depositors and the money they collect on the money they lend is what determines their profit.
It's kind of an arbitrage that they're doing, really. And banking, it's one of the oldest professions in the world. And it helps us extend beyond just a barter economy where we have to trade the goods or the services that we want to trade with somebody else. If we, instead of trading those directly, banking helps us to be able to trade those with money and then to be able to exchange on it. It just helps to expand the system, because otherwise we could get stuck in that barter system. But one of the ways the banking business is different from most businesses is that they think of a deposit that somebody gives them. That's money in the bank account, but that's actually a liability to a bank, because now the bank has to do something with it. It's not an asset for the bank. Like most businesses, if they get money, they're thinking that's an asset, not for a bank. But then the bank has to lend that money out to somebody else on a loan in order to make interest on the loan. That's interest the interest that comes in, that's money the bank can really say, this is income. But the loan itself, when they send money out the door on that loan, that's actually an asset for them. It's not just money going out the door as an expense if they've done their homework and they're lending to a good borrower who's going to repay that loan.
When they receive the money in, it kind of reminds me of the kids' game of playing hot potato. And you have hot potatoes and you're throwing them to one person. You receive the hot potato. You want to get rid of it as quickly as possible, or it's going to burn your hands. That's a liability. And so a bank, when they receive a deposit, that's a liability, because if it's just sitting there, they aren't making money.
That's a great analogy. It's a hot potato for them.
Yes, exactly. But they also have to be careful about where they send that hot potato, because they want it to return to them. And if they send it to someone who's not going to return it to them, then it's like they're not even playing the game. They're not making any profit.
Do that enough times, they could kill the best business in the world.
Yeah.
And banking is highly regulated for a good reason. I mean, some of the regulations are nonsense anymore, but our country's currency has gone through some massive changes since the founding fathers made the Continental the currency of the government. And the reason that it has is that there wasn't the controls over it. So if I give you as a banker, John, my money, I want some leverage to know that my money is going to be safe with you, and you're just going to go out and spend it or lend it to someone that's never going to pay it back. And that's where government comes in and says, okay, we're going to control this so that we're protecting our people.
That's been a problem in the banking industry all throughout history, is because the bankers, if we go way back, they would take in people's gold. There was a place where people could store their gold, and they could write a paper check and say, you can go get the gold from this banker, without having to carry the gold around with them all over the place to make their actual transactions. The problem is when bankers had all this gold on deposit, they could lend it out to person number one, and they could lend it out to person number two, the same money, because they knew they probably weren't actually going to take it out of the bank. So they could just create money out of thin air by lending it to multiple people when they only had one set of money on deposit. And that's called fractional reserve banking. It was a widespread practice with many different gold lenders or bankers throughout history, and it creates problems. So that's where the government stepped in to regulate, because let's say word gets around that one of these people has lent out more gold than they had in their vault. Well, now people are going to come to claim their gold. The banker's not going to have it. And so you had bank runs and you had crashes throughout history. And so that's one of the reasons the government stepped into this space to regulate what the banks can do with their lending practices.
When fractional reserve lending is out of control, inflation goes crazy and prices go up because the merchant realizes, hey, this isn't worth what it used to be. That's why we need regulation, but we also need an honest government to make sure that they're keeping the bankers in line.
And that kind of becomes an oxymoron because, if the bankers are stretching the rules in different areas, so the government comes in to keep them in line, but then the government stretches the rules. It's still a human institution. It's always going to have problems. And so you have this back and forth between regulation and the private industry trying to find the right balance.
So we need regulations in place to protect, to keep the banker honest.
Yes.
So that, our money is safe in the bank when we use the bank, which we all have to use the bank. We live in this world, and banking is a big part of this world. But why would we want to then be our own banker? It's because the banker is using other people's money. It's getting deposits and it's finding people who need it. They're being the middleman, and yet they can make quite a profit just being the middleman. And so if we can then position ourselves to be that middleman, we can make profits like the banker, and we can make honest profits. There are regulations in place, rules that we have to play by, but we can become our own banker. How can we do that?
It's really important that we do this because in today's modern economy, you think about what a banker's doing. They're taking people's money on deposit. They're lending it back oftentimes to the same people. So you're putting your money into the bank and then you're taking it out as a loan for a credit card or a car, a new boat, whatever it is you're buying, a business, maybe even to make an investment. But you're depositing your money with the bank in the meantime. You're trying to invest it other places. You're playing two sides of the equation, but you're not the middleman. If you could play the middleman, even if you don't use fractional reserve banking, you can come out way ahead. Well, that's the idea behind becoming your own banker.
And to be your own banker, or to even set up a public bank that the public can deposit in, the banker, before they ever start their banking business, has to save.
Yes.
They have to save a lot of money up in order for the government to say, okay, you're worthy, you're trustworthy, you're responsible, you're capable of managing money, so we're going to allow you to have a charter to take care of other people's money.
Okay, so that tells me that if I'm going to be my own banker, I have to be committed to saving money.
You have to save. The economy doesn't grow without savings. It's the savings of the economy. It's the savings of our own personal economy that allows us to expand our economy and become more prosperous and wealthy.
If you want to be your own banker, you also have to be trustworthy and honest in your own dealings. And as you look at things, you have to hold yourself accountable to what you're doing.
Let's say that you set up your own banking system. You take a loan, you say, it was really my money, I'm not going to pay it back. Well, just like a banker who makes loans that don't get paid back is going to go out of business, your banking business is going to go out of business.
That's called a default loan, and banks have underwriting for people that want to have a loan to make sure that they are in a position to pay it back. I think it was Mark Twain said that a bank is like someone that loans you an umbrella on a sunny day. They only give money to people that have the ability to pay it back. You don't need an umbrella on a sunny day. So when we're our own banker, we have to be very careful about how we manage the money that we're borrowing from the insurance company, in this case, because if we don't pay it back, it's going to default the bank.
So that means we need to be organized in the records that we keep. You don't want to put your money with a bank that's not keeping organized records, that's making mistakes all the time with your deposits or with the payments that you're making to them. You don't want to take a loan from that bank. So if you're setting up your own banking system, you want to be able to keep records about the loans that you make and the payments that have been made so that you know where you are at all times.
And it doesn't have to be complicated. It can be as simple as adding and subtracting. You take a loan
That's right.
and then you pay it back. So you start paying the money towards that. You subtract it from your loan balance. Just simple adding and subtracting. If you want to get a little more sophisticated about it, we have software that is easy to use so that you can be a good banker.
The way you think about what a bank is, and a lot of people really have a horrible opinion of a bank, but again, if banks didn't exist, our economy would be more like the caveman where we're bartering for this or that, because it is that middleman function that banks do that make our economy expand and grow so that we can have our cell phones and our cars and our electric vehicles and all the things that we have and the comforts of a air-conditioned homes. And this wouldn't happen without banking, because that is what stimulates the economy. That's what gives the money for people to do research and development. And it's ultimately how we can afford houses and cars and the things that we enjoy in life.
It helps reposition the money that people have saved and getting it to the people that are putting it to work.
It keeps that money flowing through the economy rather than just hoarded up someplace not doing anything. And that is how we have to think in order to be our own banker as well. How can we keep the money that we've saved still growing, still working in our economy without just being a hoarder where we stuff it away in a drawer someplace and it's not doing anything?
Well, right now we're going to go to a break, but when we get back from the break, we're going to talk about another hot potato topic for becoming your own banker.
If infinite banking is a simple process, why does it seem so complicated? Could it be that infinite banking started out as something simple, but over time has morphed into a convoluted series of buying insurance policies to borrow from insurance policies so you can pay interest on your own money and somehow come out ahead? Could it be that infinite banking has been turned into a catchphrase and is marketed to seem exclusive, something for just the super wealthy or financially savvy? We think the answers to both of these questions are yes, so that's why we're holding a seminar called Infinite Banking Made Simple. This seminar will give you everything you need to know about infinite banking, what it is, and how it works. No mind-bending magic, no number gymnastics, just infinite banking made simple. If you're new to infinite banking, if you're somewhat familiar with infinite banking, or if you've known about infinite banking for a long time, this is the seminar for you. We will be covering infinite banking, what it is, how it works, and how to use it in your life. The seminar is scheduled for May 2nd and 3rd. That's a Friday and Saturday in Indianapolis. Make sure you schedule that time on your calendar now because, as you know, life finds a way to fill up even the most important dates. May 2nd and 3rd. Registration details are on the website linked here and in the description box below. May 2nd and 3rd, Indianapolis. We want to see you there.
Let's discuss that hot potato, Michelle, that you mentioned right before the break.
So when a bank gets a deposit, now they need to loan this money out. And the bank sees it as a liability. It's a hot potato. They need to get this money loaned out so they can make a profit. But they have to be careful about where they loan that money. And the same thing happens when you become your own banker. Just because you have access to capital doesn't always mean that you should make a loan. You have to look at, is this a good opportunity for me? If I loan it to myself, am I going to be faithful to pay it back? If I loan it to someone else, are they going to be faithful to pay it back? You have to think like a banker and make sure that you're making a good decision so that you are making profits as a banker.
There's really a few different ways that you can become a banker. One, you can go through the rigorous process of saving up a large sum of capital and jumping through all the hoops that the regulation and everything the bank has to go through.
Not practical. I don't want to do that.
That's going to take a long time. It's not practical for most people. The next two options that you can use to become your own banker is you can save up a bunch of money, put it in a bank account, and then when you need to finance something, you can go to that bank account. You can get the money out. You can finance whatever you're going to finance. You can even set up repayments back to that bank account so you make sure your money gets back to that bank account. The problem with that method is it's not earning interest or a lot of interest for you while you're saving.
Some
In
people
between
really,
all the times you're using that money.
there are people that do this. In fact, we met a young couple. His name was Greg, and they would put money regularly into their savings account. They were really good at it,
Good for
especially
them.
because they had quite a few children in their family, large family. And he would faithfully put money into the savings account, and they promised themselves, he and his wife, if we take money out of that savings account, we are going to make sure it gets back in, but we're also going to put interest in there. We
good.
have to put more in there. And I don't know if it was actually interest or if it was just their rule, got to put more back than what they took out. But it was still their money. So whenever they took out money, they started losing interest on that money because it wasn't there to earn the interest. So the money they had on deposit, they were taking it out. They weren't earning anything on it anymore.
And when it's at a typical savings account in a bank, you're probably not earning a lot on it while it is there.
So that really isn't banking, because banking, that huge amount of money they saved up is their reserve account, and it is always earning a low grade rate of interest in the background. So when Greg was doing this, they stopped earning interest on the money that they loaned because they were really just borrowing from themselves. And that's a misunderstanding about what infinite banking is. A lot of people say, well, why would I want to borrow money from myself? Well, that's not what infinite banking is. That's not being a bank. Yes, you're going through all the discipline and exercise that it takes to be a bank, but you're not being a bank because your reserve money is not earning a minimal or average rate of return while you're using it.
This is the quandary that a lot of people that believe they need to pay cash for everything are stuck in. They're still making payments, but they're making payments to a savings account instead of to the lender. They've just changed where they made those payments. And that is an important step toward financial progress, but it's not the full story. Because if you stop right there, you're going to limit how effective that you can be.
I can test to that myself. I mean, we saved up money. We worked hard. We paid our house off in 5.5 years, our first house. And we had no more financial prosperity or wealth than we had when we were making payments on the house. We sold that house and a little rental we had, and we bought for cash another house. And I had to take a second job working nights to put food on the table, because just owning your own house doesn't make you wealthier. We would have been better off at that time still making payments and having more cash to live on, because we were just using our own money. We weren't using someone else's money to buy our assets.
So you paid cash, but you didn't have cash flow.
That's right.
And I remember those times. They were challenging times.
It
was difficult. But I do want to give you a pat on the back, and I want to give Greg and his wife a pat on the back, because you had discipline to save up money and to pay yourself back. I mean, those are good things. So what we didn't have, and what Greg and his wife didn't have, we didn't have the idea of using other people's money. But we did have the discipline to save our own money. So then when we heard about infinite banking and how to add the piece of being able to borrow somebody else's money, things clicked into place.
So how do we do that? That is the third way that you can become your own banker. And that is, instead of saving up money in a savings account, you start saving money through life insurance. Now, a life insurance company, they have gone through the process very similar to a bank of getting into business. They've gone through the regulatory hurdles. They've gone through some of that. You can take a policy loan against your life insurance policy from the insurance company. When you take that loan, you're not actually borrowing your own money. A lot of people do think of it as borrowing their own money because they put the premiums in to create the cash value. And even if they're not borrowing their own cash value, they're borrowing an amount that's equivalent to it, because there's no fractional reserve banking in life insurance. So you're not creating money out of thin air when you borrow like you would if you borrowed from a bank. The banker would create the money out of thin air and profit from the interest. But when you borrow from a life insurance company, you're borrowing from the company's reserves. So you are being able to use other people's money, but where the power comes in is you're not destroying the compounding curve on the money that's in the life insurance policy. That money can continue growing. And if you have a good life insurance policy, not all life insurance policies are designed equally, but if you have a good policy that's designed for that high cash value growth, now you're getting a return that can help offset the interest when you need to take a policy loan to finance different things throughout your life.
A lot of people want to know, well, why would the insurance company want to loan me money as a policyholder? And it's because you become an asset then to the insurance company. When you're just paying premiums, you're a liability to them. They have to take your premiums and they have to work with that to make money so that if you file a claim, there's going to be there to pay that claim. And so when you borrow money from an insurance company, there's interest that you have to pay, just like a bank has to pay their depositors interest to get them to put their money there. Now, when you take that money and you've borrowed it from the insurance company, you have a liability to the insurance company because you have interest to pay. So you better be in a good position as the banker now, your own banker, to be able to put that money to work to either make more interest than what the insurance company is charging you, or to find somebody else or some investment that will do that for you.
And here's something that I love about the way that you can borrow money from the life insurance company. Let's just say for a moment that you want to borrow money from a bank. If you go there, you have to prove that what you're borrowing for is a good idea. But when you go to the insurance company, you have a certain amount of cash value you are allowed to borrow as the policy owner. And you don't have to give any reasons behind your loan. You can make that loan just because you want to. You have already been underwritten to have this policy, and that means that you have been underwritten to borrow from the policy. So all you need to do is say, I want the money. You might need to give a signature, and you get the money. So then you can choose what to use those monies for. And
that really puts you in control. That really puts you in control. With it, of course, comes responsibility. If you take the money, you want to be sure that you're going to pay it back, or that whoever you're giving it to will.
And that's why Robin can say, oh, I haven't been in the construction field before, but I've been studying it for a while, and I'm going to buy some equipment and do some construction work. And he can go to the policy and borrow the money, go buy that a piece of equipment, and start making money with it.
I like what you wrote in the last chapter of Prescription to Wealth, Michelle. You've got to start where you're at in life. And so many people have big ideas about what it means to become your own banker. And they get hooked up with someone that says, oh, all you have to do is pay a huge premium to a life insurance company, borrow it, and put the money back in. And in essence, that's, maybe the 50,000-foot view of infinite banking. But when you really get down to it, you have to be aware that you have to be honest, you have to be responsible, you have to avoid giving yourself bad loans that you're not going to pay back, and you have to make sure that the premiums that you're paying toward that life insurance policy are within your cash flow range. Otherwise, you're setting yourself up for failure. And just like many banks go insolvent because they give out bad loans or they get a run on a bank, you can go insolvent as your own banker too if you're not careful and heed the rules about how banking is supposed to be done honestly.
So what is a comfortable premium for somebody who's looking to get started with becoming their own banker?
That varies so much, John, and that's why we work with people on an individual basis and walk them through what that is. There's some basic financial rules out there that you should be saving X amount of money out of every dollar that you make and whatnot. But if you don't have debt, you should be saving a lot more. And we've talked on this podcast about how a lot of people are spending more than they make or spending money just to have experiences rather than thinking about what their future is going to look like. So those are the things that we talk about when we sit down to design the life insurance policy that's going to become the reservoir that the insurance company says, okay, we see we've got full collateral here. We're going to give you a loan.
So that's a process that we can help people with one-on-one.
We do it every day.
There are a lot of variables that come together to create the ideal or comfortable premium for everyone.
And sometimes it has to be uncomfortable because people haven't been diligent in saving in previous years, and they're having to make up for what they frivolously spent before.
Every day at McPhee Insurance, we take phone calls, listen to people, talk to them, and help them understand how they can become their own banker. We set up appointments so they can have a consultation where we can really look at their finances and how they can benefit from the infinite banking concept. It doesn't have to be difficult. You can become your own banker if you want to.
Well, today we've covered the basics of what it means to become your own banker through the infinite banking process.
If you'd like to learn more, join us for the Infinite Banking Made Simple seminar coming up May 2nd and 3rd in Indianapolis. We'll have a link in the description box below, or you can register at mcpheeinsurance.com.
The financial freedom and wealth that our clients have created by becoming their own banker is wonderful to see. It just makes sense to recover the cost of financing instead of giving that money to the bank throughout your life. So stop letting the bank have control over your financial future and take the reins yourself. Become your own banker so you can keep more of the money that you make and have financial peace of mind, and so that you can build a stronger financial future for your family. And then come back next week when we're going to be talking about the importance of money and interest right here on Wealth Talks.